Hi everyone, it's May 1st, 2016, and I'm Martin Shkreli, and we're here to talk about a little company called Groupon. We're going through investing and finance, trying to learn a little bit about this field, and we're using internet stocks as our kind of path to do that. So every week we look at a new internet stock, and last week we had a very interesting company, and this week we are going to go through Groupon as our company to focus on. So I did my Groupon model. Let's see how many people sent in Groupon models. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13. I don't know, maybe 15. Not as much as last week. I don't expect people to go through this every week. It's a pretty rigorous schedule. But that's that. So before we get into Groupon, let's do a review. We'll do a few things. The first thing we'll do is talk about the current portfolio we have. Then I'm going to do some review of a couple new topics, and then we'll get into Groupon. That'll be the schedule. So anyway, I made some decisions without the investment committee. I trust that that's okay, given that it's my money. But you guys might notice that Microsoft is our biggest long. And one of the things that is important to realize in investing is that, take a look here. We have 2.5% of our portfolio in Microsoft and 2.1% in RealPage. We actually probably have more risk in RealPage than we do in Microsoft, even though we have slightly more money. We have $5,000 more, $25,000 in Microsoft and $20,000 in RealPage. RealPage probably, whether or not its beta or its correlation coefficient to the market is that high, we all know that Microsoft has a little bit more diversification and security than RealPage, and certainly Stamps.com. So these two positions are sort of mid-cap stocks. We think about that in factor analysis, and we'll maybe talk about that some other time. But they're all sort of tech stocks as well, so they share a little bit of factor there. But mid-cap stocks behave a certain way, and large-cap stocks, Microsoft is the very largest cap stock, one of the biggest companies in the world. It's going to behave a totally different way. So I don't think about this Microsoft position as our biggest investment, even though it technically is. It's probably equivalent to a 1% position in a smaller mid-cap stock, so keep that in mind. We bought RealPage. I don't expect returns quickly, neither should you. We did get a big surprise with Stamps.com. There was a Seeking Alpha article. Seeking Alpha is a website where anyone can publish their, analysis. And here this fellow wrote, Stamps.com, a lousy piece of shit. Very funny. And this sent the stock down. I think that the stock will recover. I actually am debating asking this investment committee to buy more to double our position. We'll take a vote at the end. I think it's a good idea. And basically the article alleges that there are these investigations for false and misleading advertising practices. So these are all public. Judgments and lawsuits are all public. So the same way this guy found them is the same way that anyone could have found them. So, and I think most of the world this stuff had been known to the world. This person just doesn't like Stamps.com, I think, and is trying to leverage some news into a thesis. For instance, here the company says that he loves. The writer loves this phrase, which is Stamps.com admits that its business model has no reason to exist. So this is a bit silly, right? We all know that you can get the same service on USPS.com, but that's like saying there's no reason for TurboTax to exist. TurboTax is a very valuable piece of software, and Intuit is a very large and successful company. But you can file your own taxes without it. And, I think that that's the good analogy. I mean, just because you can use USPS.com Well, you can use the IRS.gov and file your taxes for free, and it's kind of only a sucker would ever knowingly pay for a Stamps.com account. Well, then by the same token, Intuit should be completely worthless, right? And Intuit is not completely worthless. In fact, Intuit is worth $25 billion. So I think it's a little silly, kind of short-sighted analysis. And in terms of the links, I actually read the judgments and things like that. Governments will come after companies for all kinds of reasons, and the free trial, the fact that the free trial, doesn't, the fact that they got a free trial offer, I guess, that was investigated, and it was a little too aggressive in that it converted from a free trial to an actual subscription account, I think is a little silly. That thing, those kinds of things tend to happen, and I don't think it's a big deal. In terms of the churn rate not being disclosed anymore, I don't think that's relevant. If you look at this comment, it's funny. Their scammy shenanigans are reported online. I'm only driven to try them because the USPS website is itself non-functional when it comes to buying postage. That's true. I tried to buy stamps on USPS.com, and it didn't go very well. So I think there's a reason the company is doing well. This article didn't scare me. It didn't have any new news. It didn't have any relevant news. I don't think it's I haven't met one company that doesn't have a free trial kind of offer that doesn't auto-convert and is a little bit aggressive. That's not atypical. So it didn't bother me, and I'm gonna double our position as long as my committee is okay with that. So I shorted 2 stocks. I bought some Facebook. I think that they are in the early innings of monetizing their user base, and this could be a double or a triple. It is a very large cap stock, so it's just something to keep in mind. Seeking alpha is seeking alpha. It's not a big deal. And so I shorted Netflix and I shorted Apple. So I think Netflix has a profitability problem. They have all the scale that they're ever going to get, and they still can't turn a profit. And I think that's pretty dangerous. They not only can't turn a profit, but they lose $1 billion a year, which for a $40 billion company is really remarkable. Apple I'm short because I think that if you look at the numbers, they had a really, really, really bad quarter where it was remarkable how quickly the iPhone is becoming out of fashion, and the deleveraging that'll happen to Apple will be pretty punitive. So that's kind of where I am with that. So yeah, I think we'll double our Stamps.com position. I think we'll probably make a position in Groupon as well. We'll talk about that in a minute. All right. So that's it for the portfolio. We have 11% gross exposure, so only 11% of our money is currently in the market. It's $1 million tech portfolio. We have, like I said, about $100,000 invested. The net exposure is only 4%. You guys know that I like to have a market neutral portfolio. I don't think markets go up over time, so I want just as much longs as I want shorts. All right. So let's keep moving on here. Let's go to the PowerPoint. So the first thing I want to talk about is PE ratios, and this is sort of a pet peeve of mine. I think it's one of the first things that young investors learn, and many people don't grow out of it. And even professional investors talk about PE ratios way too much. And PE ratios are basically useless. And anytime you hear someone talking about PE ratios, you should just sort of nod your head and smile and kind of assume that anything this person's saying is likely to be not too valuable. PE ratios are a quotient. Basically, it's price divided by earnings. And this can be useful if you have, it's sort of a useful concept. And you can, instead of a PE ratio, you could think of it as a payback period, right? Like in a bond, if you lent out $20 million and you're getting $1 million back every year, it's 20 years until you get paid back. And that makes sense. If you think about a company, let's say you had a company that's been in your family for a long time, and the company makes $1 million a year in net income, and you get an offer to buy the company, someone wants to buy the company for $20 million, you'd say, okay, well, it would take me 20 years more or less, to get back that money. And that's a better term for it, is actually payback period. Of course, the problem is that the net income will fluctuate quite a bit. And anyone who advocates for PE would say, well, that makes sense. If you have something that's going from 1 to 1.1 to 1.2, the PE ratio should be 30 times earnings because it's growing. And that's just totally silly. It's really a remarkably inaccurate way to do it. So one of the reasons is that the E in the PE will change quite a bit, and it's hard to use a PE on something that's not, is what I call a steady state income and steady state cash flow. And the concept that multiples expand or contract is a complete idiocy and fallacy. Multiples don't expand or contract. Discount rates can contract. Discount rates can expand, leading to changes in the price. But it's sort of like thinking like the dog is wagging the tail, that there's some PE ratio that people use, and that's how it works. So of course, PE ratios become very much, it shows their worthlessness when you think about companies that are subscale or superscale and cash flow negative. You really start to realize that looking and thinking about PE ratios is more or less nonsense. So sometimes they can be useful for very, very large cap companies where scale is unlikely to change and earnings are unlikely to change. And then the shorthand of it being a payback period makes a lot more sense. If Procter & Gamble is 18 times earnings, then you could say, well, that's a 7%, or more like a 6%, right? 6.2% dividend yield or earnings yield. And you can compare that to other yields you can get in the markets. And an inverse PE is the way to think about that. So there's some reasons where you can get that. But the PE doesn't encompass anything like maturity, or you can have different discount rates for different periods of investment. We'll talk about that in a second. You could have a small discount rate for the next few years, a large discount rate for the out years. It doesn't account for terminal growth. It doesn't account for any of those things. So PE ratio is basically worthless. A high PE ratio doesn't mean something's overvalued or undervalued. It means virtually nothing. So try to avoid anyone that says anything about PE ratios. Try to avoid looking at them. Just think about area under the curve cash flows, cumulative cash flows, integral of cash flows. That's a net present value. That's how real investors invest. So just focus on that. We're about to get into Groupon, and one of the things I wanted to mention is that the company sold a convertible bond, and I thought that it would make sense to talk about what a convertible bond is. And at some point I'll do a debt lesson, but a convertible bond is a bond, but it's very different. It's a very different kind of bond. It's actually very equity-like in that it can convert into equity. And this may confuse you, and the best way to think about it is think about it like normal debt. In normal debt, you borrow money for some coupon, say 5%, and you can't convert your debt into equity, right? You're just going to get your 5%. The company can go up by, it could be the next Amazon.com or the next Google, it could go up by 50-fold, but you still can't get any upside other than your 5% coupon. Well, convertibles are a little bit different. You actually do get the right to convert your debt and forgive your debt basically to the company and convert it into stock. And so typically that conversion price is higher than the stock price. So Groupon, I think their conversion price is at $5. So this company lent money to Groupon, I think it was $250 million, and they said, okay, you have to pay us interest. It's debt, so you of course have to pay us interest, and you have to pay us back the $250 million because you borrowed it from us, plus interest. But we also have the right, at our election, we have the right to convert our debt into stock at $5 or so. So if the stock goes to 100, of course they would prefer to convert their debt into stock, and that way they can sell their stock and they can realize that successful 20-fold growth in their instrument. Convertible bonds do have lower coupons than traditional bonds. So let's say Groupon, the reverse happens. Let's say the company does very poorly and it goes into the toilet. Well, you feel much better owning the debt because at least you're going to get your principal back most likely, and your interest. It's less interest, but it's better than losing money. So it's a way to get equity upside without the downside. Now, of course, if the company really goes into the toilet, then your debt may not get paid back either, and that's also a risk. So in any event, that's kind of the way convertible bonds work. And at some point, I'll talk about debt in more detail. But for now, let's head into Groupon, because we're really starting to get a sense and a picture of the internet sector by having looked at several of these companies, some very large companies, some middle-sized companies, some pretty small companies, and I've enjoyed it very much. And Groupon is a fascinating situation. This company was founded in 2008, and they've experienced this amazing growth. I think what people forget is when a company is doing poorly, people forget where it came from. And this is a company that, and I'm generally positively disposed to it, so that's the spoiler alert. There are this is a company that had huge growth, and then recently has fallen into some trouble. And the question is, well, can they turn themselves around, or are they going to continue to, I don't know, stay in this state of affairs? So we'll talk all about that. So basically, I you can build all these models and things like that, but one of the things that you got to do is try the service. So I actually tried the service myself, and I got this little Groupon. It's like a coupon, I guess. So basically, I found these 15 bottles of wine. I have all this expensive wine here, and I don't always want to drink it. So if I'm on a date and the date doesn't know the difference between Heartwood and Oak, 15 bottles for, I think it was for $30? I think it was for $30. Let's see. $65. There we go. So this is $5, less than $5 for a bottle of wine. And of course, I have these really expensive bottles of wine that are hundreds or thousands of dollars or tens of thousands of dollars a bottle. And I don't always want to open those bottles of wine, especially if we're dealing with a ratchet situation. So I'd love to open one of these bottles instead. So basically, this, and I'm running out of, I have a lot of expensive bottles, and I don't want to open them up. And only for special situations. So here I'm getting 15 bottles for $65, which is great. And so I have to figure out how to use this. It's a little frustrating, because basically here we have a $30 fee for shipping. It's only valid in select states. It's kind of a pain in the neck. And I use Groupon on the phone, and basically virtually all of the offers were for spas and massages and kind of things like that. Occasionally there'd be something that piqued my interest, like eye exam. I have poor vision, so I'm often getting contact lenses or glasses or whatever. And I once a year, like anyone else, I should go to the eye doctor. And I saw that there was a 50% off an eye doctor or something like that. Now, obviously, I'm a very different consumer from many people. I don't know how else to put it other than that. It's not just because I'm wealthy, but there's also some other features. I don't love discounts. Like, for instance, the idea to me of getting a big discount for a massage is weird. Like, do you want the service? Do you want to pay for that service, I think, in full? Because you want or a haircut or something like that. You kind of feel weird having a 80% off haircut, don't you think? Anyway, I'm a very different consumer, so I'll just sort of leave it at that. But the point is that I tried the service. It's kind of interesting. The idea is that there's this local kind of feature where, here's Greenwich Village is not far from here, and you get 50% off a mani-pedi. I've never had a mani-pedi, so I'm not about to start. But, all of this sort of local stuff that is, here's something that would be attractive to me, I guess, right? I need an eye exam with a $300 credit towards frames and lenses. $25, that's a pretty good deal. So there's definitely, and I wouldn't feel bad about taking money from Cohen's Fashion Optical. That's no problem for me. So there's definitely some attraction to this product, and I tried it myself, and I think it makes sense. And the company has 50 million customers, so that's not a small number. 50 million customers is pretty impressive, to say the least. And so what's ended up happening is this company struggled quite a bit. They haven't been profitable basically ever. They say they're profitable, and we're going to dig into that in great detail, but this is actually the company's history since inception. They started in 2008, they had no revenue. They had 15 million in revenue in 2009, which is very funny because this was actually the same amount of revenue. $15 million is the same amount of revenue Amazon.com had in their first year. That's right. So if we pull up Amazon.com, I did the same exercise. In 1996, Amazon did $15 million or so in revenue. And the next year, Amazon did 148. Groupon did 313. So Groupon had a faster pace than Amazon. It ended up kind of slowing down, but these were almost superimposable. Groupon being a little bit faster than Amazon, and then slowing down and Amazon taking over. But it's a pretty incredible kind of concept. And to look at sort of the paths of each of these companies. And the number of customers has also been amazingly logarithmic, but it's slowed down recently. You can see that there's been virtually no growth. And the market's punished Groupon quite a bit for this. It's basically destroyed Groupon's stock price. And I look back, and Amazon's never had a lull in their growth, but if you look at eBay, there are definitely some periods. Here was a period where eBay had a serious lull in their growth, where they had a 2% year over year and a 5% year over year. And they never quite have recovered. In fact, after the super growth period is over, usually you get a modest or no growth period. And I think that that's not uncommon. But eBay's still worth $26 billion. So you have to sort of keep things in perspective. And so Groupon, and I'm a fan of this as a stock. I think I'm going to make an investment. Groupon has $3 billion of revenue. And remember, we're not in the business of... This is the number one mistake investors, I think, make, and I've said this many, many times. We're not in the business of good versus bad. Groupon is bad. Let's get it straight, right? They're not growing. They're not, unprofitable. Crappy product, in my opinion, etc. What's an example of a quote-unquote good company? I don't know, let's see, Amazon.com, growing rapidly, profitable, great product. All of this is meaningless. It is about value. I think you guys understand that, but it's just something to really keep in mind again. When you look at this company, you sort of say, oh gosh, I don't know, they're not growing, they're not profitable, why am I interested in this? Well, it's all about value. This is about $1 billion enterprise value and $3 billion in revenue. And if they can just get a 10% margin, Amazon is profitable now. If they can just get a 10% margin, that would be a $300 million in net income, which would be 4 times earnings, and a very cheap stock price. It'd probably be worth $3 billion. So you'd get a double in the stock. So all they need to do is hopefully do some cost cutting, etc. And we're going to carefully look at that and make sure that we understand all of that. Phil, how are you? Talking about RevRec, we'll go through that in a second, I guess. So I went through this very, very carefully, and there's a couple of misleading things here that are really, really super interesting. Not misleading, but easy to trip up on. So the first thing is that Groupon has this cash flow. I just did the last 5 quarters here. Groupon has this cash flow that's way above net income. And if you look at where the delta is, it's almost completely in stock-based comp. Well, what's interesting about stock-based comp here, you can see the trailing 12-month stock-based comp is $138 million. Okay? And so their cash flow from operations is, TTM, is almost $200 million. And every year, in fact, it's been about $200 or so million. Now, the way they, cash flow from operations, it's net income plus D&A and plus stock-based compensation. You add those two back in. So you get $200 million per annum cash flow from operations. Now, that surprised me when I saw that, because I saw that the enterprise value is only 1.2 billion. So you make your money back in six years, which would be an incredible value investment. But the reality is that if stock-based compensation is $125 million and CapEx is about $80 million, so it turns out that they're roughly break even. And so the stock-based comp is tricky because you might ask yourself, well, if it's $125 million, how do you value that stock-based comp? Because typically, when you give out stock options, you have to value them by the Black-Scholes model. The Black-Scholes model, if you know it, is not that accurate. Let me show you what the Black-Scholes equation looks like. Let's see. Here it is. We'll just go here. Okay, so it's not a terribly complex. It looks a little complex. It's not a terribly complex equation, but all it basically means is that there's the option to buy a stock is worth something, even if that option is out of the money, and what exactly is that value at the money? It's a function of certainly time and the volatility of the stock are the basic two parameters. This volatility is very hard to measure, and you basically have to think about how volatile will the stock be. So in any event, the thing about Groupon is almost all of their stock-based comp, and I did this complicated analysis here, and you can go open this in the share drive. Basically, all of the stock they give out is restricted stock units, and you can actually value those very easily. Basically, it's a stock price multiplied by the amount you give out, and so it turns out that even though that's not cash compensation, it is very quickly convertible to cash as opposed to an option, which is a little more abstract. So it turns out that the company is not profitable if you include the stock-based comp, and the only way they'll become profitable is through revenue growth or cost cutting, of which they're trying to do both. So we're going to talk about that in a second. I do think the company can grow. North America grew 4%, and I know that they dropped 2% last quarter year over year. But if you think about it, they did grow 4% in North America, and they are exiting countries from Europe and the rest of the world, presumably that are unprofitable. So the idea is that I do think they can grow because their biggest business is growing, and the other businesses, it's not fair to say that they're shrinking because they're consciously exiting them completely, right? So there's still a lot of research to do for me on Groupon, but I have a suspicion that they can grow. Their CEO is an Amazon executive, which to me is a pretty good pedigree. And with respect to kind of what he said on the conference call, it all sounded quite good to me. I don't know how easy it'll be to execute, but I do think they can execute some of it, and it sounds like they're executing some of it. If you look at what they did last quarter, it's sort of a brand new business plan. So from turnaround companies, you hear a lot of the same old, but here you actually have a different plan. So if you look at marketing expense year over year, that's practically doubled, which is not what you typically do. It's not what you typically do in a turnaround is grow your costs. But they're thinking of this as an investment. They say that with this increased investment, they've been able to acquire a bunch of new customers. They said they got 1 million new customers with this new spend. So $43 million to acquire 1 million customers is about $43 a customer. And if you're getting $100 or so per customer per year, that's pretty good. I guess they're getting $60, but billings they're getting more. So it's still a pretty good deal, if you ask me. So this marketing investment is pretty smart. In fact, they have been underinvesting in marketing and overinvesting in sort of other expenses. So if you look at headcount, this kind of alarmed me. They dropped headcount by 14% year over year, but the cost of selling general administration only dropped by 3%. So they dropped headcount by 14%, but didn't save that much money, which made me wonder if they can truly cut costs that well. In fact, SG&A dropped about the same amount as revenue, so that worried me a little bit. They've been spending virtually all of their cash on buybacks, which is kind of like a high risk, high reward concept. They bought back a lot of stock over the years, so we'll see how that turns out. But if they can grow even a tiny bit and cut their costs, they can reach a margin that makes sense. It's pretty hard. It strikes me that even if they get a 5% or 10%, in this case, it's sort of a 10% operating margin, which is very small, very, very thin. It can be a very valuable company. It's very premature. I think have to definitely look at it more closely. But I increased the discount rate because the turnaround is hard to do, obviously. But there are already signs that they're doing it. So by putting in a high discount rate and a very, very modest revenue growth expectations, 4% growth for 2 years, and that's it. And then a maturity of a decline, and I get a 30% premium to the current stock price. Having 50 million customers on the internet and this amount of growth from the first 6-7 years of your business, I think is pretty attractive. A $3 billion in revenue for $1 billion enterprise value. Again, it would seem to me like there's a lot of ways to make this investment work. I'm not totally sure how exactly, but I kind of believe in the management team, and I think this is an interesting speculative value long investment in the internet sector. So that's kind of my 2 cents. Let's open some of the submissions and see what other people thought. This is from Rachel A. Rachel A. Okay, let me close my model and see here. Okay. Cool. So Rachel seems like did more homework than I did. You got these, got the breakdown of revenue. I didn't know Groupon getaways were only about 8%. That's helpful. I don't like this sort of notes thing. You could probably do better than that. Order up. I heard them talking about Order Up. I didn't know it was is it its own website? It looks like it, right? Buffalo, New York? This stuff you can just put in the model. Company is in a major transition period. That is true. Living Social. Google offers. That'll get terminated, I'm sure. Google offers. This, yeah, it's already. See, this is a good example of how hard it is to make it work, right? Google offers is no longer in business, so I don't know what you're doing, Rachel. All right, let's see here. This is a good model. Neat, nice, I like it. Let's see the numbers. Yeah, okay. maybe these are modest expectations, right? Yeah, I think you're right. It's not crazy for them to start growing again. That's right. Margins are okay. This is strange. I don't know how you shouldn't grow. You shouldn't forecast COGS like this. They should be at least thought of as a percentage of revenue. But you have margins expanding, and it looks like they're focused on expanding margins. Now, of course, you're always focused on expanding margins, but it sounds like they have some ideas on how to do that. Now, I'm a little nervous about that because if you really want to expand margins, you can cut out all the stuff that your customers maybe don't like, and then you kind of create a website that people don't like anymore. I don't think they'll ever get this profitable. We'll see. 7% discount rate is a little high. I mean, you're basically having the company going from making no money to making a lot of money. That'll be quite a bit riskier. And the higher the higher risk your expectations, the higher your discount rate should be, and that's what balances, right? That's what balances it all. So this is like my scenario, except even a little better than that. And that's why the discount rate should be even higher. It's going to be hard to achieve this business plan. That's why the discount rate should be higher. If you turned all the growth down, right, then the discount rate could be really low. And that's sort of how you think about it. So this is pretty good. I think there's a little bit missing with respect to just sort of what I'm looking for, which is some ability to sort of understand this local marketplace and how Groupon can help drive it. For instance, one of the big things is half of the revenue comes from mobile. And so, what is a good way to get our heads around diligencing, that this sort of local opportunity. So that was pretty good. Maybe a B+. Here's a Groupon email. I should get one of these of me and my cat. That'd be good. Or maybe just pictures of me. That wouldn't be narcissistic at all. Huh? All right. I think I did this wine thing. Tennis sounds fun, actually. That actually sounds kind of fun. I tried playing tennis this summer. It was out of shape. Too out of shape. After work party cruise. I guess you can go with your friends. That could be fun. These aren't so bad. See, this is if you go on the mobile app, this is like 90% of them look like the massage packages, and I'm not a massage kind of guy. See, another fitness eyelash restoration. I don't need that either. All right, Tristan. Let's look at Tristan's model. I wouldn't mind while we're at it. Let me check out this Living Social while I'm here. Kind of looks the same, doesn't it? Let's see, company about us. They also have a turnaround. These local companies have not done well, huh? Corporate reorganization, layoffs of 20%. I wonder what their last financial. Revenue in Q4 was, this is much smaller than, much smaller than Groupon, but if you look at the gross profit is much higher than Groupon. It's weird. They're not a public company, right? But they kind of report anyway. Doesn't make a lot of sense to me. Who's this guy, Gotham? eBay. The guy came from eBay. Curious what their last financing was. That's what I'm looking for. Living Social sells Ticketmonster to Groupon for $260 million, and then they sold Groupon sold Ticketmonster. So go figure. Wow. They went from a $6 billion valuation to $300 million. Pretty bad situation there. Okay, so let's take a look at this model. Tristan stepping up to the plate. Kind of bad formatting and stuff here, but I didn't think they had debt. Okay, you kind of get what I got. Pretty accurate. How'd you build your revenue? Same way. Revenue times customer. But just guessing on this. Now this is the important stuff, is, you know, what is the essence of their business? Why does this business exist? And basically the idea is that local businesses need to drive traffic somehow. And they do that in different ways. And sometimes local businesses have too much inventory and they need sales, and Groupon is a good way to sort of get rid of inventory and things like that. So driving traffic through, especially on a services business, right? Like, you have fixed costs as a services business. So yeah, there you go, Akil. I think he's just adding the cash here. NPV of the business, total NPV, etc.
This isn't helpful, obviously. Yeah, so someone has to get at the essence of what, these are all well and good. Anyone can do this, right? But what you really need to do is become philosophical about why does this business exist, right? That's really the question, and why should they earn a profit? Remember that local business is already operating at small margins, so for them to give up margin to Groupon seems like a problem. So, they do have $3 billion in revenue, but the question is, how do they how do they provide a service to the end user as well as the local business? And that's kind of the question. And can they is the most important question. So I think this is pretty good too. No intelligent thought of the actual business. Numbers in a small part of the value. Okay. Let's see, who's this guy? Adnan. Alright. Groupon is an easily replicable dying company. It attempts to both restructure and sell share, cannot mask that it has not barrier to entry and not powerful enough brand name. Short. Alright, so you don't think the company will ever be profitable. This is a very awkward model. You're flirting with trash here. Let's see. I don't understand. You have gross margin of 30,000%. I think you should check your numbers. Seems a little off. You have that numbers don't add up problem. Basically, you just put some random numbers in here, and then you have this one sentence that sounds flamboyant but isn't helpful. Small waste basket. Probably something bad. Okay, there you go, Adnan. All right, here we go. Gaji. Better not be a virus. This better not be a virus. I will sue you. All right. Would you lend your car to this guy? I wouldn't. I know you focus on the CEO's appearance too much. You also made some not so nice comments in the chat room, which I think you're not in the US, but using that word to describe someone in the US is not, let's just say, not a good idea. There are, there is an algorithm. If the CEO's fat, tan, and bald, then it's a short. That's the old joke. That's the triple threat. I always get nervous when people are too tan because it means that they're not working enough. Okay, let's see here. It's kind of an awkward model. You have the customer going down, customer growth rate going up, kind of steady revenue, slight growth. Gross margin, it's kind of an awkward format, but it works. Okay, so you have them getting to profitability. Low discount rate for a challenging outcome, right? I mean, you have them going from losing money to making money. That's not going to be easy. And that low of a discount rate seems like more of a risk. And again, you didn't really get into the... Oh, I like this. This is nice. This is very nice. Shows the percentage of active customers, and the ARPU gives you different values. But I think there's some kind of a couple of mess ups in here in general, but this concept is pretty neat. What's Akil saying? Yeah, the whole idea that I really like this sensitivity analysis. This is smart. Very, very nice. You know, I think there's some mistakes, so the analysis doesn't work, but, and again, no deep thought on the actual business itself. So it's pretty good. I'm going to give you the same rating I gave the others, even though you have some fundamental mistakes. Yeah, no, we'll get to Ben's model. I'm sure it'll be exciting. All right, Calvin. All right, Calvin doesn't even bother to drive revenue off of something. Not good. This is pretty cool. Yeah, that kind of thing. Kind of thing happens with young investors. Young executives. It's a good find. Very good find. Definitely a good find. Calvin. That's the kind of diligence I like to see. Groupon Groupon declining in ranks? Yeah, it's still one of the most followed websites. As long as it stays in that top global rank, that's fine. It's funny. Number 2 downloaded shopping app. That's impressive. This is good. A good competition list. Check this out. Like I've always said, competition is kind of over theorized, but it's good to check out what these companies are doing, just so one gets a sense of what's working and what isn't. This was the old. All right. Okay. Or did I close it? I'm confused. Try it again. Am I looking at the, what am I doing here? I'm lost. Oh, right, so, sorry for the confusion. Yeah, I don't think that's right. Huh, I didn't know Alibaba owned 6% of Groupon. All right, Rachel, I already did yours. My name is Casillo. Please receive this email with gratitude and honor. Perhaps in advance, collect my apologies if I do something wrong. I will go back and correct them. Thank you. That is interesting. All right, it has a virus apparently. I'm just gonna get some chips. I'll be right back, guys. Okay. Tank is running low on energy. All right. Groupon needs to become a celebrity news or a reality TV show. This is pretty funny. humorous. Alright. I can't even understand this shit. Alright, enter the dumpster. Alright. We got the champion here. Harris. The youngster, the young gun. Let's see. Looks like you got this wrong. Like you'd put this in millions, or this in thousands and this in millions, and I don't think they have debt, dude. This is a terrible job. I expect more from you, Harris. Come on. What is this garbage? It's fundamentals. It's like you can't be a basketball player and not know how to dribble. This is like not knowing how to dribble. Not good. Alright, let's check this out. You know I like my line, dog. You know I like the line that separates the estimate from the historical. Alright, how do you do this? Alright, you did it the same way everyone else did it, which is not very good. It's kind of pretty arbitrary, even though you're moving the arbitrary nature from the revenue line to a different line. It's still arbitrary, you know? Alright, that was disappointing. Sorry, Harris. Alright, Stanley, let's see. Stanley A. I like this pros and cons of the CEO. Pretty good. Hugh. Sounds like you got, and this is a little awkward. They should just be in millions, you know? You're doing it in billions, I guess? this is the kind of deep thinking one should expound on. I mean, this is a small. ARPU is low for an e-commerce company. It should slowly increase. Well, all right, that's not bad. You know, anytime like you're sitting in a model saying like I have not been intelligent enough, you know, that should be a sign like this guy was smart enough to say the ARPU is low, but maybe put a table of how low it is, and you know, there's ways to think about Groupon. Like there are other like coupon clubs and things like that. There's people pay for Prime as a good example, Amazon Prime. There's a lot of ways to sort of think about these two things. You know, why would they have 50 million customers? And what do businesses with 50 million customers typically look like? There's a number of deep thoughts one could have had on this, and most people, so far, all of the models, none of the models really, there was any kind of deep thought. Let's see if Michael Flanagan, who's a reigning champion, has some original ideas here. It's the app performance, okay. Groupon scheme. From a paper I wrote in 2011. I don't think they pay early investors. When have they ever paid earlier investors? I want to check that rev rec. Be very curious about the revenue recognition if that's true. In this statement, many of the businesses that have participated in Groupon have given up after realizing it does not bring in new customers. Well, there's 50 million customers and $3 billion in revenue. I definitely want to understand the rev rec. Yeah, basically a procrastination is, that's what they'd love to do. It's a good business model. I don't think it's illegal. I don't know. The merchant app. Well, you did this one like everyone else, it looks like. Michel is a man, by the way. He's emailed me to make that clear. Rip off and poor customer service. Yeah, definitely wish they probably wish they took that Google offer. Yeah, they'll probably get rid of some of these countries. Interesting. Both Amazon and Google shut down their local businesses. Amazon owns 30% of Living Social. Interesting. They didn't want to tell me. Did you ask? It's interesting. Oh, did they IPO at 30 billion? Fair enough. Chapter 11 in 2018, he forecasts. They have more cash than they would take too much cash. It doesn't add up. Oh, here we go. Net cash. Where do you see the debt? I didn't see any debt for Groupon. What are you talking about? Show me on the balance sheet where you see debt. Accrued merchant and supplier payables. Were you supposed to think about that as debt? Because then you'd have to think about receivables. Huh. is interesting. It's not, you know, it's obviously not debt in any way, shape, or form. But the idea that they have these merchant and supplier payables doesn't seem, they seem to always have it. And it may be a function of revenue, but it's definitely something to look into. It's interesting. All right, well, I think this model, despite its sort of weird appearance, is actually probably the best one so far. Michel, our Italian friend. Yeah, it's the most deep thought I've seen. That's not saying much, but you know, not bad. All right, Alexandros. Let's see. Well, if they have the 250 in debt, remember they also have 250 in cash, so keep that in mind. I like how you went on his LinkedIn. It's weird. I thought it was weird that he was only at Amazon for 3 years. Company will probably be bought out. That doesn't make sense to write. It is kind of foolish. Oh, what's sale? Retail me not. I don't know this one. All right, let's see. Okay, you have it, the company doubling, but I don't think that's, let's see, maybe it may happen. It's just, this is, you know, you're not sort of explaining why all this good stuff will happen to this company. You have them cutting costs and growing revenue, and it's all well and good. Anyone can make a model that says that, but why will it happen? Why is that realistic? That's the question. My model may be trash, but there's no doubt in my mind that Groupon is trash. Gotta have an open mind in investing. Open mind. Can't be convinced of something very quickly. That's not how it works. 60 Minutes does Groupon.
By now you have probably heard of the company called Groupon, even though it started only 3 years ago as a side project of a quirky young Midwesterner. What he did was reinvent the coupon, turning it into a digital tool for bargain hunting at your major neighborhood stores. The company took off almost overnight. It's global now, raking in hundreds of millions of dollars a month. Wall Street took notice. This past November, Groupon had the biggest initial public stock offering, or IPO, of any internet company since Google. The company's worth jumped to an unexpected $18 billion on the first day of trading. And yet, Groupon is the subject of a fierce debate. Will it revolutionize how we shop in the long run, or just end up a passing fad? The answer depends in part on the 31-year-old who came up with the idea, Groupon's founder and CEO, Andrew Mason.
The story will continue in a moment.
Groupon takes advantage of stupid and hopeful small business owners.
Groupon is essentially a voucher that's worth money that you can take into a business and use like cash. When you subscribe and you get these emails every day, it's a great way to.
It will make me happy to watch the company crumble and burn.
And find out about really cool local things to do.
The deals are at least 50% off. So for example, a $40 meal for a $20 coupon, or a half-off hot air balloon ride. Groupon has 150 million subscribers who get a daily email with deal offers from local businesses.
Is it usually for something that we don't really need?
It could be. Sometimes it's for a restaurant or a massage or
That kind of stuff.
a session in a sensory deprivation tank. But sometimes it's for a hardware store or dry cleaning.
The company began in 2008 at the height of the recession when everyone was looking for a bargain. And then it grew so quickly, so fast, it took everyone by surprise, including Andrew Mason.
Once we started Groupon, the success was intoxicating, and it was just this rocket ship ride that you couldn't let go, but you didn't want to let go either.
Not only did Mason launch a retail revolution, he brought the company to a place where, in this economy, they hire up to 150 new employees a week.
How many people do work for Groupon?
Across all 46 countries that we're in, we have about 10,000 people.
Groupon's
Whoa.
headquarters in Chicago is part tech startup, part old-fashioned call center.
Hi, this is Sadie calling with Groupon.
Unlike most .com rocket ships, Groupon looks like a real business. Where most websites rely on algorithms, Groupon relies on actual human beings.
And did you want to go ahead with the 25 for 50 for the mani-pedi deal? Or
What these human beings, the salespeople, do is think up deal ideas, then convince local merchants to offer them at half price.
So what we're going to do is actually customize the deal specifically to you.
Groupon has found out by trial and error how to present its deals. Used to be male and female subscribers got the same emails every day. Now Groupon is tailoring its offers by age and gender.
Yeah, turns out that guys don't like to live on laser removal or pole dancing lessons.
Or Brazilian bikini waxes?
Yeah.
The merchants don't necessarily make money. The offers are half price to begin with, and Groupon takes nearly 50% of that. But it's a marketing tool that gets lots of people in the door. When the Shed Aquarium in Chicago ran a Groupon, 14,000 people showed up. It's a group coupon, a
Now,
Groupon.
Groupon is expected to go
Took a
public.
spam business,
Mhm.
a junk mail business, and somehow made it entertaining and cool.
We do realize that we're sending people an email every single day, and that could get annoying. So there's got to be something else there that keeps you engaged and keeps you from unsubscribing.
That something is the absurdist humor in the daily deal write-ups. 400 writers and editors, more than most newsrooms, come up with hundreds of these pitches a day with twists and crazies and logic. Here's one for a dentist. Humans developed smiles as a way to deflect predators in the wild and former bosses in the grocery store. The loopy write-ups give Groupon its personality, which seems to seep down from the very top. Andrew Mason is known as a little wacky himself. As a gag, his executive washroom is a porta potty. And look at this.
Exhale, step back into planking position.
Can you name another CEO with a demo on YouTube
Inhale.
in which Christmas tree in your skivvies doing yoga?
No, and it's a huge problem.
The problem is that he now runs a huge company, and his urge to be goofy makes him one of the most unlikely corporate CEOs you'll ever meet.
I think if there's any difference between me and a traditional CEO, it's that I've been unwilling to change myself or shape my personality around what's expected.
So here's a question that you hear a lot. Is Andrew Mason ready to be a CEO?
Am I as experienced or mature or smart as other CEOs?
A big company's
Yeah.
worth as much as yours.
Yeah, no, probably not. But there's something I think very useful about having a founder as the CEO.
According to Forbes magazine, it's so useful, Groupon is the fastest growing company ever. Enter their offices and there's the Forbes cover, but it's surrounded by other covers of high-tech has-beens, as if they're asking themselves, could we be the next to fall by the wayside? It's a good question.
Well, the greatest challenge to their business is that it's unclear that it's defensible.
Andrew Ross Sorkin, financial columnist for the New York Times and host at CNBC, says the biggest downside is how easy the model is to replicate.
There are 500 other competitors out there that all want to do and be Groupon. Amazon is getting into this business. Others are getting
Google.
into this business. Google is getting into
Giant.
this business.
But what Andrew Mason will tell you is that so far they've killed them all off. So far.
So far, they have spent an extraordinary amount of money to market their business so that they've been able to beat back a lot of the competition.
Right.
The question is, if you're spending as much money as they are, whether you can actually create a profit long term.
That's given rise to doubts about the very sustainability of the company. For one, they spend more money than they take in on such things as wooing new subscribers, and it's expensive to employ 10,000 people. By contrast, Facebook has less than 3,000.
At the moment, they have yet to turn a profit
They've yet to turn a profit at all.
at all.
Hi, thanks for calling Groupon. This is Bethany. How can I help you?
Add to that horror stories from merchants, like the baker who made 102,000 cupcakes for all the Groupon buyers. But with the steep markdowns, she lost $20,000. And businesses complain Groupon customers come once and never want to pay full price again.
Oh, okay, I'm sorry about that.
But Mason was still the new boy wonder until the summer, when he decided to make Groupon a publicly traded company, and it had to open its books. What raised eyebrows were the accounting tricks that made their huge marketing costs disappear on paper. And they also double counted how much money they were bringing in. So on their books, they made $60 million in 2010, when in reality they lost $420 million. Analysts began calling Groupon unviable, a Ponzi scheme, and wondered if any grown-ups were minding the store.
There are things we would have done differently and we would love to avoid.
But it really hurt you. It looked as though something was fishy.
I think the big thing about Groupon is just people have never seen anything grow quite so fast, and that made people want to dig in and be skeptical. And
No, but you contributed to it. You didn't put the honest revenue figure down, you left out marketing costs. It seemed like a bush league mistake. That's what.
I don't think it's fair to say that it wasn't an honest revenue figure, and a bush league mistake that our auditors looked at and thought was like, smart people can get this stuff wrong. We're inventing a new industry. Like if we were smart, evil people, we would be more cunning and subtle in our evil ways, you know?
At the time, Mason couldn't address the mounting criticism because companies are prohibited from giving interviews in the lead up to going public. But his impatience drove him to do something that drew the wrath of the regulators. He answered the criticisms in an internal memo to his 10,000 employees, and sure enough, it leaked.
Here's some of the adjectives that were used to describe you when that memo leaked. thin-skinned, impetuous, and childish.
Look, I'm not gonna pretend like it's been fun to sit here and have something that we've poured our hearts into over the last 3 years and see it criticized while we have our mouths shut. It's kind of like we've now been hazed, you know. We're like Wolverine, and our skin has been melted off. We've had adamantium fused onto our bones, and it's made the culture stronger as a result.
I'm not sure what that means. But Groupon ended up having a wildly successful opening day, trading on NASDAQ as a public company.
On the first trading day, your personal worth jumped to $1.3 billion. Are you checking the stock price every minute? Be true, come on, how often?
I checked it once yesterday afternoon, and then I felt dirty, and I haven't checked it again. Do you know?
No, I don't.
Now I want to know. How's it doing?
Well, it's been zigzagging just above and below the initial trading price.
You just hit buy?
Buy, I bought it.
Mason continues to expand the company. He showed me how he's moving deals onto mobile devices.
Oh, I wanna get pampered.
But the questions remain. Will Groupon become part of our lives like Google and Amazon? Or will it be relegated to the .com dustbin? And will the founder have to tone it down?
I saw you at NASDAQ, I guess it was, and there you were in this Armani kind of suit and a tie.
Okay.
And completely
What's
shaved.
an Armani type of suit?
Really
Exactly,
nice
is that
suit,
what
an
it is?
expensive
Okay.
suit. Was that the first tie you ever owned? Do you even own the tie? Did you rent the tie?
No, I own over 4 ties. Yeah.
Did you think about showing up in a suit and tie for 60 minutes?
No, I asked. I asked if I should,
And
and they said that I shouldn't.
you should.
So maybe, you know what? Maybe I am changing. Because I bite my hat.
Yeah, that was interesting. Almost done. We'll save the best for last, I'm sure. All right, Ben Goldstein. We expect Markov models now, or? The CEO looks like a complete beta, but he does have some marketing background. I did some back of the envelope predictions, and the US dollar is set to strengthen throughout the year. That's good to know. Yeah, I agree with the statement that this is it's a bit of a different niche from Amazon, Google, and Facebook. Yeah, exactly. Restaurants can use the short term. It's sort of a good supply demand fit. But yeah, I don't know that they've been able to execute it.
This guy is quite the philosopher.
Your revenue numbers are just, looks like they're wrong. Oh no, wait, hold on. Yeah, still the growth is. All right, so we have one last model to go through from Neil. Was orbits a thing? Isn't that travel, orbits? Okay, so I thought that this was overall kind of a pretty poorly. I thought the entries were poor. I guess we have one last late entry from Coded Realm, and it doesn't look much better than the others. I think that's really important to sort of keep in mind that. Just filling out the numbers basically doesn't mean anything. Anyone can fill out numbers. The hard part is actually really thinking hard about the business itself. And so some of you did that pretty well with looking at different sort of reviews of Groupon, but I didn't find any of the forecasting too intelligent. One person's tried to get there with this whole, well, they're only getting $100 a customer or $60 a customer, and that's really low for a company like this. And I think that makes sense, and I have that sort of inkling and that feeling as well. Obviously, with $3 billion in revenue, they have a lot to work with. It's a real business, and you can monetize those 50 million customers. You have 50 million paying customers. I mean, that really is saying something. So the question is, how do you make that work? The management team has their work cut out for them, no doubt. But I didn't get any conviction from any of you, either positive or negative. Obviously, there's a lot of negative commentary, which is the current consensus is very negative. you tend to make money in Wall Street being counter consensus or contrarian, and in this case, very few of you made that case very well. So, in any event, I think I'll keep thinking about Groupon, maybe make the investment. Definitely interested. It definitely seems like an interesting turnaround opportunity, sort of like Yahoo in many ways. So that really is it. Next week, maybe y'all can do a somewhat, I think, similar business called Angie's List, ANGI. And you can send me your model at this email address, shkrelimartin@gmail.com. Ticker of Angie's List is ANGI. As usual, I'll critique your model for free right here next week, next Saturday or Sunday. And thanks for joining, and we'll see you later.